Good morning, all. We will begin momentarily. Thanks for your patience. Thank you all for joining. We'll begin in a minute. Good morning. Welcome to the SCB Chamber's COVID-19 Resource Webinar Series. I'm Peter Warda with the SCV Chamber and will be hosting today's webinar. We'll have a question and answer session at the conclusion of the presentation. If you wish to ask a question, please use the question feature located at the bottom right of your control panel. Simply click on the drop-down where it says question and you may begin typing. Press enter when done. Your question will go to the host. As a reminder, please feel free to send your questions throughout the webinar. If during the call you are experiencing difficulty, please email hello@scvchamber.com. We are monitoring that email live during the webinar to assist participants. In addition to the Chamber's webinar series, the Chamber has a comprehensive COVID-19 resource page, which is constantly updated. Please go to scvchamber.com and click on the COVID-19 menu item. You can find details on HR compliance, unemployment benefits, and business disaster financing options, among many other vital resources. The Chamber is also pleased to announce the launch of a portion of our Focus SCV Leadership Program now and transform it from a small classroom format to a webinar for our entire business community. We have been working with the College of the Canyons and Employee Training Institute for months to prepare this high-quality programming as part of Focus SCV and are pleased to present a two-part virtual program on emotional intelligence to help support our business community. Please visit our events page for more information and to register. As we begin our program, we want to thank our presenter, John Vance with Vance Wealth, for helping put together today's important Chamber webinar. John Vance is president and founder of Vance Wealth in Santa Clarita. He is a certified financial planner professional, and since 2003, Vance Wealth has served as a premier financial planning practice and committed to helping clients and families succeed every step of their financial journey. Given the unprecedented volatility in the capital markets, business owners need to take proactive steps to protect their businesses and wealth. John Vance will examine permanent changes to market dynamics and provide practical advice on how to leverage tax and investment strategies you can incorporate into your planning now, take advantage of opportunities such as low interest rates and cheap energy, and consider COVID-19 scenarios and other market dynamics that will impact your portfolio. Please welcome joining me, John Vance.
Thank you, Peter. Peter, can you hear me okay?
Perfect.
Okay, I just want to make sure because I know we're having a little bit of technical difficulties. So thank you everyone for joining me today. I'm looking forward to covering this great topic. We're going to go through some economic updates as well as just kind of cover what's happening from an investment perspective. And so, Peter, if you can just be on the outline for today's conversation, I'm assuming you are, but since I can't see what I'm doing, I'm flying a little bit blind here. So going to give a brief update on just COVID-19, not going to go through the health issues, but we're going to just talk about what's happening from the governmental side, what the economic impact is, and really from that perspective is really talking about the case for optimism and why we think that economically we will actually come out of this pretty well down the road. I do want to make my case for what we can call the roaring 20s, and I don't mean the roaring 1920s, I mean the roaring 2020s, and then strategies for the eventual recovery. So as things normalize, what are some of the things that you can be doing as an investor to position yourself for the recovery? So as we look at the next slide, which is our current reality, one of the things that's pretty remarkable, if you think about we had just been in the longest economic expansion of our history. So from 2009 until today, we've been in this recovery, and again, this was the longest one that we had seen since basically the long economic expansion in the 90s. And so I know officially we're not in a recession, but we are in a recession. If you look at the unemployment numbers, if you look at the slowdown in the economic, a lot of economic indicators, we are in a recession. I do believe once we get to July, that'll be officially announced, but we all kind of know that that is the case. And so we don't need to wait for the official numbers from the government, which technically is 2 consecutive quarters of negative GDP growth. And so because this thing, the pandemic hit us so sharply, so quickly, we haven't had the opportunity to declare the official recession, but we're in one. So the fact that this economic expansion is going to end, and it's remarkable to think about that this is basically in our history the first virus-induced recession. We've had recessions in the past that have been driven by potentially market overvaluation, by asset bubbles, by Fed policy, by wars, things like that. But this is the first that's virus induced. And so one of the things is, as we look and we reflect of, well, what's going on and what do we think is going to come out of this? And on the right hand side here, I have changing of the guard. If we look at the last 10 years, this recovery or this expansion that we were in, most businesses thrived in that dynamic. It really was a period of time where things really recovered and did nicely. And so, when we start looking at what this next maybe decade will look like, I think it's going to change a little bit from most businesses thriving to, the best are going to thrive. And from the businesses that we're seeing and that we're working with, those that have a really great culture, who have amazing leadership, that's going to matter. And those are going to be the businesses that are going to thrive in this dynamic. And, it's really having, I think, a pragmatic look at the future and helping take action for not only your team and your employees, but also for your customers. And that's what we're seeing. We think this is going to be a decade that's going to be strong, but it actually is going to be where the best really thrive in this dynamic. So when we look at the stimulus, we've been talking for weeks now about how the stimulus was going to be massive, and it's clear that more is coming. And so the chart on the left here shows the cost in today's dollars, basically, of the impact of the stimulus. Now, if you look at the yellow on here, it says 2.2 trillion. Those are basically phases 1 through 3. The Federal Reserve has already announced, the government has already announced that there's more stimulus coming. And so this is going to, when we look back and see the amount of the dollars, it's probably going to dwarf this 2.2 trillion. My guess is will probably be upwards of maybe 5 trillion of total stimulus. And so if you look at the impact of, well, how does this differ compared to other times? So if you look at the New Deal, and it says cumulative in there, 830 billion, again, in today's dollars, and then you look at the last financial crisis we were in, which was 2008 to 2009, about 1.8 trillion. And so you can see this is massive, and it really has to be. This is unprecedented, where we're asking the economy to shelter at home. Many businesses cannot operate, and with that, we have to throw a lot of money at this. And just to give you some historical perspective, I know people are worried that we might slip into a more of a depression type of a economic scenario. And that's highly unlikely, possible, but highly unlikely, primarily because what the Federal Reserve and the government are doing is highly stimulative, and they're putting a lot of things in place to kind of prop up the markets to make sure that this doesn't spiral into something that we can't get out of. And so if you look on the right-hand side, is this idea of phase 4 is likely on the way. Well, what does that mean? Well, we've been seeing a lot of headlines around infrastructure spending to create jobs, hazard pay for frontline responders, potential debt relief for individuals and households, finding a way to make sure that they don't default on debt, and then getting direct funding for hotspot cities, like New York. And so phase 4 is coming. I will tell you, with the speed of execution on what actually is, how quickly they got out phase 1, 2, and 3, phase 4 is probably going to take more time. And the reason we think that is that there's a lot more political maneuvering, a lot more political fighting that's going to happen on phase 4. The first 3 phases were kind of easy, low-hanging fruit, so to speak. And so a couple quick things before we move on to the next slide. I just want to mention, I don't have notes up here, but there's a lot of stimulus in place for businesses. And there are things like the EIDL, which is basically a loan program at low interest through the SBA. There's the PPP program, which is potentially a forgivable loan or a grant based on keeping your employees working. And so one of the things that I can tell you, because I know there's been a lot of, especially in the media, a lot of misconception, the money is moving. I have countless number of clients who have been getting money, most of it coming this week, a few last week, but most of it has been coming this week. And so if you applied for it and you've been having decent dialogue with the SBA, that money is likely on its way. I know we're hoping to get it faster, but at the end of the day, they're moving a few $1 trillion. It's up to the government to make sure there's not fraud in this, make sure they get it to the right people. And so again, I can tell you firsthand accounts that money is coming and it has hit accounts. And so I have confirmation of that. So be positive around this money is going to come for relief. Certainly there's going to be businesses that are left behind, but make sure you advocate for yourself. Make sure you get out there and understand how this works. And, that's where the chamber can come in and provide some guidance. That's where our firm and other business consultants can come in and help you. But, utilize these programs to keep your business afloat. And if you don't think you need it, just get it anyway, because it'll give you a nice cushion in case this crisis lasts a little bit longer. All right, next slide. So this is now transitioning a little bit into the investment conversation. And so it says the fastest 30% decline in history. Well, what does that mean? Well, when you think about the fastest 30% decline in history, basically means the stock market dropped the fastest that it ever has. It dropped 30% in 22 days. So that was the panic that we basically lived through from late February through the end of March. 22 days, down 30%, bigger than the Great Depression, bigger than most sell-offs. That's what created a lot of panic. That's what created a lot of uncertainty. And so that's why the Federal Reserve really stepped up, is to support the markets. And so it's really unprecedented. Obviously, we're in unprecedented times right now, but we have seen some recovery. And so here's the real dilemma that we have as investors, is that if you think about a bull market, which is a rising market, and a bear market, which is a declining market, a bear market is a decline of more than 20%. So clearly we went through this 20% decline. We got down as much as 30. And now the recovery, we're actually up about 25% from the lows. So in a course of basically 6 weeks, we went from a bull market to a bear market back into a bull market. Well, that's a little misleading, right? So I think many of us still feel like we're kind of in this bear, meaning the economy is going to take some time to mend. So the stock market's been so volatile, so it's been a little bit chaotic. But so let's jump into the economic data, which is the next slide. So at the end of the day, stock prices, real estate prices, business valuations, they will all improve when the economy improves. And they tend to follow, meaning they tend to, over time, move in line with the economy. So if the economy is healthy, the stock market's healthy. Now, the one thing that's really important to recognize is that the stock market tends to move before the economy moves. And so we saw the stock market sell off 30%. At that time, unemployment numbers were just starting to come in. And so the economic data hadn't deteriorated. Well, now the markets have recovered a little bit, and the economic data continues to get worse. So just know that over the long term, the economy and the stock market and again, real estate, they're going to be closely tied. However, in the short term, they're not. And the stock market tends to move early, and it tends to recover sooner. So a lot of people are kind of saying, you know what, I'm going to hold off making decisions until the economy improves. And, a lot of times you're going to just look at that and say, you know what, I've kind of missed it, because the economy is going to take a fair amount of time to recover. And so when I talk about bullish on the U.S. economy, I mean bullish over the next 10 years. Over the next 10 weeks, it's really hard to know. Over the next 10 months, again, hard to know. But because of the stimulus in place and really the spirit of our business owners around the country, I do have confidence that we're going to get back on our feet pretty quickly. But we do have some headwinds and tailwinds. And so, I do think there's a tremendous amount of tailwinds that are going to really help businesses thrive, but we can't ignore the headwinds. So regulatory and compliance issues. Right now, many companies are dealing with HR challenges and challenges that are stemming from COVID-19. We have massive national debt issues and ongoing deficits, and with adding these trillions of dollars of stimulus is going to push us close to $30 trillion. Well, that's a headwind long term. Demographics. We have an aging population. It's been something that's impacted Europe and Japan, and we have an aging population, so that's going to be a headwind in the future. And then tight labor market and rising labor costs. And so maybe the labor market is loosening up a little bit, obviously with unemployment numbers going up quite a bit, but there has been rising labor costs, especially here in California. So those are kind of the big picture headwinds, and honestly, those are probably not going to go away anytime soon. Those are really going to be part of the economic conversation going forward. But the one thing that I really want us to focus on is the tailwinds. And really, this is why this presentation was entitled The Case for Optimism. So when you think about how can an economy thrive, what are the big drivers? How do you get an economy to thrive? Well, number one is record low interest rates. So you think about interest rates, that's the cost of borrowing. So when you have record low interest rates, it allows homeowners, individuals, businesses to borrow money at cheaper and cheaper rates. You're seeing SBA rates, line of credit rates that are all sub 5%. That makes operating a business, investing in a future, companies investing in plant and equipment, it brings their cost way down. Number two, cheap and plentiful energy. You think about the U.S., we're in such a good position today than we were 20 years ago. We are now net exporters of energy, so oil and natural gas. So what's a better environment for a nation like ours that are basically bringing manufacturing back, continuing to produce goods here? When you have cheap and plentiful energy, we can operate an economy in a very efficient manner. Number three, expanding Fed balance sheet. This is a little technical. This is just another word for the Federal Reserve is printing money. And when you talk about printing money, that just means there's stimulus in the economy. There's dollars that are going into the economy that will fuel consumption, that will fuel business activity. And a lot of what the SBA is doing, and even some of the Main Street lending programs, is putting business capital in business owners' hands to either shore things up and make sure they don't go out of business, or number two, so they can focus on growing when we come out of this. I have a note on here about nationalism versus globalism. This is a little, maybe a tad premature on putting this in place, but if you think about what that means is, nationalism is focusing internally, globalism is looking at this global economy. And it seems to me, especially with what's happening today, is that nationalism, when we come out of this, is really going to be the theme. Let's bring manufacturing back. Let's make sure we control the production of our medicines and our healthcare and our masks and our gowns and so many things that we're importing from overseas. I truly do see that we're going to have a massive manufacturing boom as we bring stuff back home here to the U.S. And then technological advancement. I mean, our economy, our markets, we are the leader in technology, and that really puts our U.S. economy in a great position. And then the last one is current tax policy. I know by default, many of us think we pay too much in tax no matter what. But when you look at current tax policy, especially going back over the past 40, 50 years, we're in a really favorable tax environment. And so that helps to stimulate growth with companies, when individuals to keep more of their money that they earn. All right, so let's move on to the next slide. So the case for the Roaring '20s. So if you can tell from my voice, I'm obviously extremely optimistic about where we're heading in the future. And this was even prior to COVID-19. I think this is a setback, clearly, but I do. One of the things that I know that it makes our economy so strong is we have the ability to kind of purge, reset, and rebuild. And so there's clearly going to be a fair amount of industries that are not going to recover very well from this. Airlines are going to struggle. Leisure, hospitality, cruise liners, they're going to struggle. Old line retailers, like the Macy's of the world, these are probably companies that should have been out of business years ago. And basically what we're seeing, this is going to force their hand. So the case for the Roaring '20s. Now, when we look on the left-hand side here and talk about leading technology of the '20s, well, the 1920s, that doesn't look like that doesn't look like amazing technology, but 100 years ago it was. Then we start painting the picture for our technology of today, AI, genome mapping, 3D printing, and 5G. Those are just a kind of sampling of some of the technology that's really going to fuel our growth going forward. So on the next slide, I have 3 slides in a row. These are going to look a little bit similar, but when you look on the right-hand side, you're going to be able to see a bunch of brands that identify the U.S. economy, and I guess at that time. And so one of the things when you start thinking about being an investor and being a long-term investor, and you look at historical periods in our country, we basically have a history. This is not a mandate, but we have a history of going through periods of time where the markets tend to be very flat, and they can go up and down, but flat, and we go through these expansionary periods. So I'm going to walk you through 3 scenarios, and where we talk about what was driving the flat markets, what was driving the expansion. So in this scenario here is kind of it's the study case that we all know, right? The Great Depression. Markets peaked in 1929, and if you look at the chart below, basically did not exceed the 1929 peak until about 1950. And so we had 25% unemployment, wrapping up World War II, or going into World War II, wrapping up World War II, and then we hit the 50s. And what happened in the 50s? And so this was a revolutionary time for our nation. We had post-World War II America. We had the growth of these industries, airlines, the interstate highway system. We had automobiles and phones reaching critical mass, meaning they're utilized by most households. And you can see the stock chart there of the S&P 500 index went up 500% over that 18 years. And if you notice, it's not a smooth path along the way. We had a couple recessions during this period of time, so this is not a straight line. But one of the things that we try to encourage investors to look at is, ignore the dips. Look at the long-term run. If you focus too much on the dips, it keeps you from focusing on the long-term benefits of being an investor. So we're going to go on to the next slide. So that covers the expansion through 68. Then we looked at the flat market of the 70s. This was coming off the heels of Vietnam. This was a period of time when we ended this decade that mortgage rates pushed up to 20%. We had massive oil shocks. We remember the oil lines of the 70s. And that was an environment where the markets basically went sideways for that roughly 12, 13-year period. Then we hit the start of the 80s, and arguably this was the largest creation of wealth in the history of the United States. And I guess I should say the history of the world. This was a period of time from 1982 to 2000, 18 years, the markets went up 1,400% or 14 times. And what was driving that? Well, in the U.S., we had the benefit of the globalization of great American brands like Coca-Cola, Nike, Procter & Gamble. Then we also had massive PC penetration where people were switching from the typewriter to personal computers. And that was really driven by Intel and Microsoft. These were companies that were forming in the early part of this 20-year period. Then we had the significant change of the big box stores, the Home Depots, the Walmarts, the Costco. And if you think about what happened is you can see along the way, this is not a smooth path either. You can see there the stock market crash of 1987 where the market dropped over 20% in one day. And you can see along the way as we headed up. But again, the important thing is the direction. The markets went substantially higher over roughly a 20-year period, and it was because of innovation. It was because of major changes. And so when we go to where we are today, so the headline says, don't allow fear. So now we're on the third chart here. It says, don't allow fear to drive investment decisions. And so, when this period of time here, we started this at a time where in 2000, we had the dot-com bubble burst, which was really kind of known as the tech wreck. We had September 11th, which in 2001, which threw us into a conflict that we're still battling today, but we are in the height of that conflict for that period of time. And then in 2008, we had the financial crisis. Basically, the consumer debt bubble collapsed. And so if you look at the sideways move, that basically means from about 2000 to about 2013, the markets essentially went sideways. And then from about that period of time, now you can see where we believe we're in an expansionary environment where the markets have a lot more room to grow. And you can see on this chart, it does show the current decline there that we're living through. So this is the expansionary environments are never without recession or without challenges. But the key is what's the innovation that's going to change? COVID-19 is actually going to accelerate this change. Zoom is an example. Now, I'm not making specific stock recommendations, so don't take it this way. In fact, I think it can be dangerous for everyone to look at, hey, these are great companies. They're kind of a no-brainer to invest in. You still need to be cautious about investing. But you think about what's happening, our behaviors and how we're making decisions, technology we're using, it's actually forcing our hand to do it because we're stuck at home, because we're maybe not working in the office. All of these things are forcing us to change behavior, and not only change behavior, it's kind of forcing us to be comfortable with this and not kind of push it off. We don't have a choice. We have to make these adjustments. And so you think about what are the big areas where we're seeing massive transformation: food, banking, mobile services, content generation, and then treatments for major disease or the healthcare side. So I'm going to go through a little bit more specifics on that. So on the next slide, just want to talk high level. So our firm is affiliated with Raymond James. They have a great research team. So when they looked at where do we think the best sectors are going to be, and so they identified, information technology, communication services, financials, and healthcare is really the overweight areas where they think the the bigger, longer term trends are going to be for the markets. And we think that, depending on how you're investing your money, making your decisions, this could be useful. What I am going to go to is, and we're not going to go through companies, but on the next slide, which is on slide 16, it says the themes for the Roaring 20s. We're going to go through 3 slides here where we talk about, what does this really mean? So one of the big themes is better living, and when you break that down, is we're looking higher quality food. Many people are moving from fast food to more fast casual. Organics are growing at 10%, whereas like traditional food categories are essentially flat. So we're seeing a change in the way we consume. And the way we buy our food, the way we go to restaurants. Next one on here is active lifestyle. So we already kind of know that this was a big part of our society, and frankly, I think with us being quarantined at home, it's actually helping us prioritize exercise, having a more of an outdoor experience, people going on walks. This is already occurring, but I think even more so now, it's really forcing our hand. Mobile services, this is kind of a clear issue that we see. Diet and exercise now accessible on your phone, banking accessible on your phone, and dating. The numbers are, I think it's either maybe 1 in 3 people are who are getting married or actually meeting online, and so it's pretty remarkable stats on that. And then banking, the younger generation, my mom who's in her 80s, she's not using her iPad to do her banking, but the younger generation, they don't have a need to go into a physical bank. The banking system will change. It's already starting to change, but what's going to happen over these next years is going to be transformational. So the next slide is medical breakthrough. I am obviously not a doctor. I'm not a medical expert. Some of the big things that we've read through in terms of some of the major changes that we're seeing, genome mapping technology has vastly improved. And so all this basically means is individualized treatment. So where you can actually get treatments, whether it's on a pharmaceutical or a surgery base, that is designed for your genome, your DNA, and it's designed for you. So treatments for major diseases. This is going to have a massive impact. And right now it's too expensive, but that's going to come down dramatically as the technology improves. Pain management crisis, right? We know there's a massive issue there. We saw a bunch of companies that have been in lawsuits. There are better pain management solutions. This is a massively growing area that will change, will change the way medicine is delivered. And then the bottom one here, virtual healthcare. Think about virtual healthcare. I shouldn't say nobody. Many people didn't even really know what virtual healthcare was. Now, with stay-at-home orders and a lot of the things that are happening, we're now going to be more accustomed to doing this, getting our healthcare in a virtual way. It's going to provide tons of new efficiencies for insurance companies, doctors, and patients. We're going to get better treatment through technology. There's already a ton of monitoring capabilities that we can utilize through healthcare. So this is a real growing part of the economy. And the good news is, from a U.S. perspective, is we have some of the best technology here. So, and then the third page, this is kind of the easy stuff. This is the stuff we all know about, right? So you think about the network is changing the world, and you think about new content, streaming media. That's the Netflix of the world, right? Social networking, interactive gaming. We know interactive gaming is a highly addictive area. Obviously, right now, there's more and more people that are staying home, playing games. I mean, you see the numbers that Microsoft has been publishing about, how much more people are online. So it's pretty tremendous. And then financial technology, again, banking moves to your phone. And then the Internet of everything. Connectivity solutions are going to be in this growth phase. And you think about how many devices are in your house. Most people have 20 to 30 to 40 devices connected in their house, whether it's their garage door, their front door, their cameras, their different devices, their bed, their washing machine. I mean, it's pretty crazy when you start thinking about the Internet of everything and how connected we are becoming. And then technology on vehicles, right? And so this is why there's so much potential going forward, and really why we want to make the case for an amazing decade that we're going to have. We do need to get through these tough times, but we're confident that we're going to get through them, and we have some amazing industries that are going to really thrive in this dynamic. So if we go on to the next slide, so we are big believers of globally diversifying portfolios, where you have money spread around the globe. Living in the U.S., you want to be overweight U.S., but we even think U.S. is going to do better than international. And the big reason is we have a much better tech sector, we have a much better healthcare sector, and we have a much better communication sector. But also, the Federal Reserve and the government are responding to this crisis with so much financial support that we think it's really going to prop up and help our businesses thrive. And so that's one of the reasons why we do favor U.S. out of here. Even though international looks really deep, we think the U.S. is going to do well. We still want to maintain diversification globally, but we think U.S. is likely, especially for the next couple of years, going to thrive in this dynamic. So I do want to just get into the weeds a little bit on a couple concepts. We talk a little bit about what's called value investing or growth investing. Growth investing has been by far the best place to be for the last 5 years. And so what's happening is we're seeing a lot of portfolios that are getting out of alignment, and people are allowing them to have a massive growth tilt. But if you actually look back to 1970s, this goes back about 50 years, and it shows you different categories: small value, large value, small growth, and large growth. I don't want to go into all the nuances of what all that means, but that's something easy to Google to define that. You can see small value as a category versus small growth. You can see small value historically has done much better. And so we're living in an environment where growth is thriving. We still think growth is going to do well, but don't neglect the value side of the portfolio. So the reason why value over the long term, it historically has been giving much better returns. Now, history does not mean it's going to repeat, but there's a lot of data that suggests that that it will. If we then look at why value, when you think about returns after a recession. So if we are in a recession, on the next slide it says why value returns after a recession. If you look at the bottom left corner, there's a box there, and it says LMS and VBG. So that's large, mid, and small, and value blended growth. And so if you look at year to date, and this was as of last Friday, the large cap growth category was down 8% for the year, and small value was down 29.8%. And then you can see the rest of the number. And so clearly large growth has been the best place to be. And, it's because it's dominated by the big names that we're familiar with: Microsoft, Amazon, Apple, Google, Facebook, right? So while we do think those are going to be really strong places to be, let's look at this data on the right-hand side that shows if we look back over the previous recessions going back over the last 50 years, the bottom shows small stocks, the top shows large stocks. The light green is growth, the dark green is value. So if you look at we're going to look at basically some of the data. This shows 1 month after the recession, 6 months after the recession, 1 year after the recession, and after 3 years. If you look at the after 3 years data, which as long-term investors, that's the data that should be most relevant, you can see that small stocks after 3 years, and particularly small value, performed up 83%. Compare that with large value at up 41%. And then the darling of today, large growth, which was up 27%. So when you think about kind of where you should be positioning money, I'm not saying you abandon on growth stocks. It's just mainly make sure you have balance in the portfolio, because anything that's really popular, that means it's more expensive. And so just, again, maintain diversification. So I'm going to skip this slide, the why value now. I think I've addressed this enough. This is slide 22. I'm going to go ahead and skip that. And then we're going to move on to slide 23. So we're going to wrap up here with a couple summary slides. So investment strategies. So these are just some high-level themes. Number one, stay broadly diversified. And I have on there, be careful with individual companies. A lot of people are jumping right now to say, let me buy Zoom, let me buy Netflix, let me pick all these clear winners. And one of the things we have to be careful of, there's a lot of volatility with these individual companies, and just be careful there. We also don't know what companies might fail. So being broadly diversified, you insulate yourself a little bit better than by being too specific on individual names, where what if you pick the wrong company and it goes out of business? It's hard to recover from. So that's number one, stay broadly diversified. Number two, a lot of people are using mutual funds and ETFs. The last 10 years, passive/index type of investments have done way better. We think that the next 10 years, active managers are going to do better, those that have high conviction. And high conviction just means they get to pick winners and losers. So instead of being in a dynamic where you're picking the broad markets and you own everything, using managers that are very selective and saying, I want to own this, I don't want to own this. And given kind of our theme of this next decade, that it's going to be a great decade, but there's going to be winners and losers. And so that's why we think active managers are actually going to be a better place to be. So look at your portfolio allocation and see what kind of mix you have right now, because most people are way overweighted on the index side of things. Number 3, underweight companies with high debt, pension obligations, and sensitive to global pandemic issues. And so those are sector-specific issues around high debt, pension obligations, and have ongoing issues with any global pandemic that we might have in the future. Number 4, own large cap tech. Our big U.S. companies are thriving and doing well, but don't forget small cap companies. Don't forget these smaller companies. I just went through the data on there. They tend to lead coming out of recessions, and so you definitely want to add that to a diversified portfolio. The next slide is on tax strategies. This is probably another 45-minute conversation, but from a tax strategy perspective, a couple of just high-level things. When you look at taxes, we really like to focus on reducing tax liability over your lifetime rather than just this year. And I am not a tax professional. I technically cannot give tax advice, so this is just more a high-level strategy. And so talk to your tax professional about that. That's really important. But focus on what can I do today to help limit my tax liability over my lifetime, not just focus on any given year. Because we're in a favorable tax environment right now with lower taxes, it might not make sense to accelerate deductions and to do things that are going to give you massive write-offs. It might make sense to hold on to those for future years to get some better deductions. And a couple things for business owners. If your profit is down or you're anticipating a loss, consider a couple things. You can take your IRA or your 401k and do a conversion into a Roth IRA. That means you move money from a pre-tax account to an after-tax account. You got to pay tax when you do that. But with the markets being down, you can convert that, and as the money recovers and grows, you've now changed an asset from a taxable asset to a tax-free asset. So that's one thing to consider. And then also tax loss harvesting, because we've had a lot of volatility in the market. A lot of your taxable accounts may have some losses in it. So consider loss harvesting, which basically means you're taking some of the losses, reinvesting them in similar investments, not identical, but similar. And that way, when things recover, you have this tax write-off, but you still own the investment. And then, talk to your tax professional about some creative tax strategies within the tax code to reduce your taxes. What are some of the things you should be doing? A lot of times you're not getting good tax planning strategies from your tax professionals, so lean on them, talk to them, make sure they're helping you through this time. All right, so the next slide is just a couple simple things on business refresh. So the easy thing is, every call that I've been having with business owners is we've been talking about their cash, their liquidity. Make sure you have liquidity. Liquidity is what's going to allow us to weather this storm. Refinance your debt if you can. Refinance buildings, refinance your house. Get yourself in a position where you don't necessarily need to take money out, but if you need it, then that's okay. But just refinance your debt. Get in a position where your payments are going down. Make sure you access the stimulus money through the PPP and the EIDL. And the other thing that I don't love, but I just wanted to make you aware of this, you can withdraw up to $100,000 penalty-free from retirement accounts. So if you're truly in a position where you need access to capital, you can't get it anywhere else, you can get money from your IRA, your 401ks, without penalty. You still have some tax issues to deal with, and they'll defer it over a few years. But you can Google that. You can reach out to us if you have questions, but you can access your retirement accounts. And then regarding cash, be patient until you're ready to deploy cash. I've had more calls with people saying, I have some cash on the sideline, should we invest? The short answer is yes, it's a good time to invest. But if you're going to need this cash to pay your bills, maybe hold on to it a little bit longer until we get a little bit more clarity. And then on the right-hand side, upgrade to business. Eliminate unnecessary expenses, invest in technology to improve your team's productivity, and cut underperforming employees. Those are the 3 things you can do right now to improve your business. Summary. Okay, so you just heard me kind of rattle through all this. Secure liquidity for your business, improve business efficiencies, investment in retirement accounts, focus on long-term, avoid the short-term noise. That gets us in a lot of trouble. Balance your portfolio between growth opportunities and value plays. Make sure you have diversification. Develop long-term tax strategies that are going to help your business and your family. And the last one is be optimistic. There's a lot of reasons to be bullish for this next period, and really looking at this as the roaring 2020s. So with that, I know it's like drinking through a fire hose. I covered that information in about 40 minutes. I hope you enjoyed it. Hopefully it's valuable to you. We have a slide here on questions. I think Peter's gonna kind of jump in and take it over, but I know I really appreciate you listening in. I hopefully provided some insight that it will help you, help your family, help your business thrive in this environment. And if there's anything that we might be able to do for you, feel free to reach out. And thank you very much.
Thanks, John. We'll now begin questions and answers. Again, if you have a question, please type it in your chat box, and we'll do our best to get you the necessary information. John, I'll start off with this first question for you: is how often do you recommend rebalancing a portfolio?
Great question. So on rebalancing a portfolio, most of the research data suggests that annual rebalancing is sufficient, meaning just once a year. And basically rebalancing is, if you have a target allocation of a certain percentage in different types of investments, is that you just bring them back into balance. Because what happens is when you invest your money, certain things go up more than others, certain things go down. And so after a course of a year, the account will be out of balance. So the whole idea about rebalancing is getting it back into alignment. Now, real quick, just add on to that is annual is sufficient. But we also like to recommend that when you see volatility in excess of 20%, which is what we've been living through, that you should revisit your accounts and look to rebalance so even though annual is desired, if you're going to have more volatility, changing that to a kind of real-time looking at it now definitely makes sense.
Perfect, thank you. I know earlier, a couple slides ago, you were mentioning people jumping on Zoom or GoTo and buying shares there, just given the current climate. Can you give an opinion, I guess, and not necessarily if you can speak right away on it, but can you give you an opinion on would it be feasible for people to jump in the airline industry right now in stocks with what's going on?
Yeah, so that's a good question. So, here's the thing. If you look at the economy right now, there's about 20% of our economy that's not really back to work, right? So we have retail, we have airlines, we have hotel, we have cruise industries. Those are not back to work. We don't know when those are going to go back to work. So one of the challenges with like an airline is that even though companies might start looking, healthy because they're getting some bailout money from the government, we don't know if they're going to be back online. We don't know if they're going to remove the middle seat and not allow anyone to sit there. And so we don't know what the what the economics are behind like jumping into the cruise industry or airline. So people are nibbling at these stock prices because they have sold off like 60 or 70%. I would just caution against, there's certain industries that we don't have enough clarity on and might be in a world of hurt for many more years. And so where our focus would be is, yes, there's going to be some value plays with some of these industries. It's probably a little bit too early, but we mainly want to focus on where's the growth going to come from and what are the things that will grow, even if we stay at home for an extra month, which I hope that doesn't happen. But I guess it comes back to this whole idea of make sure you're broadly diversified and be careful about these individual names. There's going to be company failures. There probably will be a few airlines that don't make it. There might be a cruise ship or company that might not make it. So that's where that's where you can really put yourself in a bad position financially, is if you pick the wrong company and it goes to zero, because you can't recover from that.
John, how do you factor in the impact of U.S. debt and deficit?
Oh, that's like the $1 million question that I feel like I've been getting. I've been doing this over 20 years. And, I remember, studying in school back in the late 80s, early 90s, and we were told how bad our debt was at the time, and it was less than $1 trillion. And somehow now we're at 25 trillion and, our economies are thriving. And so, our financial systems are so complicated that it's really hard to wrap my brain around the fact that, yes, this should be a bad thing for the economy, but it hasn't been. So the question is there a day of reckoning? And so the concerns with deficit long term is that it's going to be highly inflationary, which means that the government's going to have to print money and it's going to cause inflation. The other reality is that technology is so deflationary. The impact of what technology does for our economy brings the price of goods down so much that it's almost offsetting some of these deficit issues. And then additionally, with interest rates so low, it's allowing our politicians to be sloppy with how they spend money. And this has been going on for decades. This is not just recently, this is for decades, but it allows them to be sloppy with how they spend or how they tax because rates are so low. So out of the history books, debt should be a massive problem. I don't think it's going to be a problem for this next 10 years. I think it's going to be another one of those kick the can down the road. Nobody really wants to seriously deal with it. And frankly, I don't think the politicians have the stomach for it. And so I think it's just going to be one of those things that we're going to say, oh, this is a huge problem, but we're not going to see it. We're not going to see it manifest itself for the next 10 years. So I guess the summary of that is I would be concerned longer term, maybe the next decade, not this decade.
Thank you. John, I don't know if you've had a chance to see this. I believe it's fairly new, but just kind of wanted to see your opinion on it. Is I know people are starting to receive the stimulus check, but House Democrats have introduced the Emergency Money for the People Act, which is going to provide Americans over the age of 16 who make less than $130K a year, $2,000 every month. Do you kind of have an opinion on if that's something that could work or what we see happening with it?
So it's geared for people who are making too much money to receive the original stimulus check?
It's supposed to be more, it's supposed to help more. It's for anyone over the age of 16 and makes less than 130,000 a year.
Oh, less than 130. Well, I thought it was so I think it's a good idea for them to commit to like a monthly amount. But the challenge becomes, what do you do if they're also on unemployment? So somebody who's making who gets full unemployment right now is $465 a week. The government already added on $600 extra per week, so that's now $1,000 or $1,065, which annualizes $50,000. So if they're adding another $2,000 on top of that, I mean, I think I like the policies where they're not overly discriminating against too many people, because then you're trying to pick winners and losers and just kind of blanketly give money out. So I have been in favor of getting checks out to individuals. The question becomes, when does that stop? If the state of Texas decides we're going back to work and California says we're staying home, does the federal government still send it to everybody, or are they going to be selective? So I think the application of it's a little bit challenging, but I think that the combination of extended unemployment benefits and these checks are a good idea. It's hard for me to articulate whether that $2,000 is the right amount, but I think if they were going to do this at a family level, the $1,200 per person and the $500 per kid, that obviously is kind of free money that's really helping people. So again, I think it's a good idea. I just don't want to create a perpetual giveaway where it's just this unlimited amount of money for everyone. And so, stopping this is going to be probably the hard part, because when are we going to really get the all clear signal? And we don't know the answer to that yet, unfortunately.
Gotcha. John, I got a couple more questions for you. This next one, sort of similar with what you're saying. If the state of California does one thing and then another state does another, for those who've converted cash over the past few weeks, when do you suggest they get back in the market?
Okay, that's a good question. So when you start thinking about redeploying money, so there are people who are on the sidelines who are freaked out who went to cash. There are people that are earning money and have extra money to save, right? So I probably want to address both of those investors. So the first thing is, we highly recommend you have 2 years of your expenses in some cash or cash alternatives. So keep what you might need to run your business, run your household, in some safe investments, especially for what your household spending is. So 2 years. Then once you have that 2 years, then you can start looking at investing the money. So what we've been doing is kind of taking an approach with our clients is doing what's called dollar cost averaging. And so instead of just saying, you know what, I'm going to dive in the deep end today and just invest and I hope I get the timing right, is to smooth out their investments. And we think smoothing it out over the next 5 to 10 weeks is probably pretty good, for meaning every week you invest a small amount. So let's just say you had 100,000 and you said, I wanted to invest my money over the next 10 weeks. You put 10,000 in this week, 10,000 in next week, and you just do it automatically for the next 10 weeks. So I think that's for somebody who has a little bit longer term time frame, is not as skittish about volatility in the markets. If someone who's a little bit more conservative and doesn't really need to be the first investor in, and they're okay waiting for us to maybe get out of this, especially getting out of the stay-at-home order, then maybe doing it over 10 months is a little bit more conservative way of doing it. So, but the key is to have discipline, because the markets are going to be volatile. So set up some standard that you're going to follow and stick to it. Don't try to overthink it and guess. Stick to your plan.
John, I'll tie these last two questions together, and you tell me if it does make sense to put them in together. But at what point does a Roth conversion make sense? And at that same time, I guess, sort of a piece of advice for young professionals if they're just trying to get into starting to save, and whether they get into a money market or not, what's the best starting point for them?
Okay, so I think I can probably tie those together. So the Roth conversion is an interesting one. So the whole idea of funding a Roth or converting to a Roth is that you're going to get tax-free growth, right? So if your money is growing for 10 years tax-free, that's not nearly as powerful as having your money grow for 40 or 50 years tax-free. Just the compounding effect of that. So the recommendation on funding Roths and converting Roths, if you're in your 20s and 30s, if you can get more money into your Roth side, because you have time on the Roth side of the ledger. Some of you may not be eligible because there are income restrictions on Roth IRA contributions. There are not income restrictions on Roth IRA conversions. And so by doing the Roth IRA conversion, I guess the two things I would look at is your age. If you're outside of 20 years of retirement, then Roth IRA conversions can make sense. So that's number one. I might give you more than two, but so that's number one. Number two is that depending on your tax bracket. So the four lowest tax bracket right now are the 10% federal bracket, the 12% bracket, the 22% bracket, and the 24% bracket. If you're in any of those four brackets, really consider a Roth conversion or a Roth contribution, because those are historically very low tax rates. We might see higher tax rates. Somebody asked the question earlier about the debts and deficits. If we're going to deal with those, we might see higher taxes in the future. So if you have money that you can pay tax at some of these lower rates by doing a conversion, you should be able to take advantage of that over the lifetime, because you don't have to pay taxes on that money later. You pay it now. So those are kind of the two things. And in terms of just getting started, I mean, Roth amounts, you can put in $6,000 a year or $7,000 if you're over age 50. Our advice on that is just start. I mean, these are things that you should be committing to every year, because you got to build that retirement bucket. The government's not going to be there to take care of you in retirement. You got to take care of yourself, and the sooner you start, the better position you're going to be in over the long term.
Perfect. Thanks again, John. I want to thank you for the presentation and for the valuable information, and thanks to everyone who is able to join us this afternoon. For additional resources, please visit our website, scvchamber.com, under the COVID-19 tab for more details. We will be sending a copy of this presentation over to you as well. If you do have any questions, please feel free to reach out to us. We'll do our best to try to get you any of the answers that you need. Thanks again for joining us. Please be safe, be healthy, and let us know how the Chamber can help you. Thank you.